Hello guys, welcome to Go Capital. So this is going to be a second video for the binary classes, and this is the account I created in our last video, which is the first class of the binary classes. I created this demo account just a few days ago, and this is my first trade on this demo account. And as you can see, I'm trading Boom 1000, and this is the 4-hour time frame of Boom 1000. This is the same asset that when you see on the 1 minute, let me show to you, that looks like this. So these are Renko charts. So I just got this number of spikes that you can see here. Let me switch to the 5 minutes time frame so that you can see, it can be contained in one window. All right, so you see how far I've gone. I was able to target this market, and I've been on this market, and you can see how many points I have taken in this market today. This market has been spiking up. So you are going to be learning how to do something like this. It's very simple, it's not difficult, but today I'm going to teach you Crash 500, how to trade Crash 500. Okay, so even though I'm still going to teach you how to trade Boom 1000, volatility 10 1s, volatility 10, in fact all of the Deriv assets, I'm going to teach you how you can trade all of them. But this is the trade I've currently entered, and this is my first trade on the account. Let me show you the history. So this is $57 with 0.5 pips, as a 0.5 lot size rather. So, and I was risking 50, that's $48. Can you see? I was risking $48. With this now, I can actually move to break even. I can move to break even because I have done 1:1. As part of my risk management, whenever I attain 1:1, I'm always move to break even so that winners will not turn to losers. Okay, so I was risking 48 like you saw, and it has gone to 56, 57, 58. So it will be wise I move to break even. All right, so I actually analyzed the trade on the 4-hour time frame, and I also took the trade on a 4-hour time frame. So you're going to be seeing very soon how I enter this type of trades, but I'm not teaching Boom 1000 today, even though the strategy is the same for all of them. But there's going to be slight differences in how you approach using them in the different assets, though the concept is pretty clear. So let's run into it already. All right, so let's go to Crash 500. So this is what we'll be looking into today. We'll be looking at Crash 500, and the most important thing that I'm going to say is please hold on for me. Let me set this. All right, so that when I switch to the line chart, the charts will just disappear. Get what I did? All right, so I want to write now. What we'll be looking at today basically is something I've done before in the forex classes, but there's going to be a little difference. Why? In forex there is fundamental analysis. You check news and you see what what is happening fundamentally, and then when you see all of that, then you are able to come to the chart and trade in the direction of what your fundamentals have told you, whether market is going up or is going down, okay, depending on the asset. But here in binary it's quite different. This is synthetic indices. These are synthetic indices, and these synthetic indices, they are not affected by news. There are no fundamental analysis. You just look at the chart and you trade. So how do you get a direction? How do you know where market is coming from, where market is currently at, and where market is going to? Because this is the 3 questions you must answer if you are going to trade anything. You must know what price has been doing. That is, where is the market coming from? Then where is price currently at? What is it doing right now? And then where is it going to? What is it going to do? The ability to answer this question puts you way ahead, losing trades. Okay, so right now I'm going to be drawing some things on the board, things I've drawn before, but I'll be drawing them again so that you will have an understanding of what we are here to do. All right, so let's get started. So we said that in the forex market, price will move from a level. When it does so, then it will come down again. It doesn't just go up forever, it will come down again. All right, so when it does so, it will go up and get to the previous level where it came down from. That level it came back from is called the high. Okay, when it breaks it, it's going to create what is known as a higher high. So when market creates a higher high like this, it must come down again to this level here, or this level here. Now there are two different positions I just drew now, so I'm going to draw two different things. Now I'm going to draw another one here. Market moved like this and then came down and then broke this side, breaks it up and comes down here. All right, okay, so just take note of what I'm doing. Are you seeing this? So then there are many scenarios, but let me just draw these two first. I'll add other ones. So now the implication is that when market breaks a high and you've already identified that it's going to be an uptrend, that the market is trending up, then once it breaks a high, you anticipate that it will come back to this level and go up again. Now the things you are going to see in this other part of the chart is what is most important. It is not really whether the market comes back or not. It is what is here that you'll be looking at. So what is here will be either of three things, and I've mentioned them before. You're going to see things like a tweezer top in that place. Okay, so you see a tweezer top there. Then number two, you might see a bearish Rami. I wish some people call inside bar, bearish inside bar. Okay, so you can use the word inside bar. All right, so then the next thing you might see in that place, if it's a high, if it's a top like that, next thing you might see is bearish engulfing. Yes, the other thing you might see in that place, number four, is inverted hammer. Okay, inverted hammer. So these are the most important ones I normally look into. So for the case of an uptrend, this is what you'll be looking forward to find in this area. All right, in this area. So when you find those kind of things, you highlight them. Okay, you highlight them. So when you highlight them, you put your stop loss at the bottom of the pattern, then you put your entry just above the pattern, and then you wait for the market to come back and put you on a buy. Put you on that. You are going to be using pending order like buy limits, put you on a buy like this. You will cash this other move. So I told you that here is going to be your take profit. Okay, here is going to be your take profit, but there is also a better way to trade. If you are the type of person that you love to go for something beyond 1:2, then you can be trailing your stop. You know what that means? You move your stop loss to break even, just like I did for this particular boom 1000. I've moved my stop loss to break even now, so I can actually put my TP here. All right, and it will be 1:2 because I was risking 48. So if I move my TP down to this place now, this is 100. That's more than 1:2. So if the market gets here, I'll be taking profit. So but if I just want to leave my trade to keep running, so once this touches this level and it's giving me signs that it's going to break it, I'll just lock, I'll move it up again, lock half, maybe like lock $50, okay, and allow it to keep going up until I get to this 200. If it gets here, this will be more than 1:4. Do you understand? So now let's come back here. The tweezer top or bearish around me inside bar, these are the things you're going to find here. So the market will come back to it and you highlight this level and you go up. All right, let me still go back to 1000. This is actually what I saw when market broke this high like this. When the market broke it, what I simply did was I highlighted this place. Okay, I highlighted this place. This was what I did, but I didn't enter immediately. I waited for the market to enter into the block. It entered very well. So when it entered, I saw a spike. So when it spiked, then I knew, okay, it's going to respect it. So I put my trade on a buy and my stop loss just below this block. I drew $48. And when I just came back now to discover that this is happening, and I just felt like doing a class. Okay, I didn't actually plan this. Now, this market respects this particular strategy I just mentioned now. So it happens in every of these charts. All right, so let's go back to crash 500. We're going to talk about it because that's what we're doing today. So now the market will break a high to come back and zoom out to go up. Here sometimes it will not hold. It might break this one downwards and hold here. So this first scenario is what you call a mitigation block. All right, so this is a mitigation block. Let me write it out. Mitigation block. Okay, all right, so that is the mitigation block. Can I reduce the size of the text? Okay, yes, I can reduce it. All right, so that's the mitigation block. Okay, right here, that's the mitigation block right there, this one. Then for this particular one, it is called order block. So what is the idea behind them? The idea behind, okay, let me start with order block. The idea behind the order block is that trades were executed in large volume at this place before. So market moved from here with so much pressure, like with a high volume, and it went very high, broke a structure like this. So it is believed that this area where orders were placed in large volume initially, the big buyers will come back again to take other orders that were not triggered initially in this place, because when they enter the market with their big volume, all of them will not be triggered at once. Why? Market is buying and selling. When they want to buy, someone has to sell to them. So if they do not have enough sellers selling to them at the time that all the first transactions were initiated, the market has to come back to a lower price again, known as a discount price, for them to have the other remaining positions triggered. Okay, so if those remaining position triggers, then the market will move from here again. So the idea is that the market will come back to a place where it moves significantly from again. So that's the idea. So this happens in binary very often. It's not as if it does not happen in forex. It does, but I don't like to trade in forex. I like using mitigation block in forex, why I use this and this in binary. So I use both of these structure I just drew now in binary and in binary, these two structures. But in forex I use only this one. Okay, only mitigation block. While in binary I use both. Okay, so there's also what we call a breaker. All right, so what will be a breaker? Coming, market will move up like this, creates a high, then market comes down, okay, and breaks the low that was here before, breaks this low, then it comes back to this place. All right, so this area is a block the market is going to respect, but it's not a breaker until, let me draw this, sorry, Sorry about that. Okay. All right. Now let me explain what I just drew for you so you can understand. Market left here and broke a high, right? So market is now coming back to it, just as in this case, coming back to it, but did not respect it, did not go back up, but rather broke it down. This other block, when it is broken down, just as in this case, becomes a breaker. Okay, becomes a breaker. Are you getting the idea? So once market breaks an order block and comes down, right, and it comes back to that order block you just broke down, that's a breaker. So the idea is that the market is going to sell like this. All right, so that's the concept. This thing happens in binary. Okay, so now for the case of the mitigation block, let me draw another thing to explain mitigation block to you. Market goes up, comes down, when it goes up again and comes down, but broke this low here, then comes down, and you expect that it goes down again. So let me highlight it for you. It's actually the same thing. Okay, now this becomes your mitigation block. I will explain. Mitigation block. All right, now this pattern I drew here is actually the same with this, just that it's reversed. For this one, let me change the color of this. This is equal highs. Sometimes it can be like this. That means this high is lower than the previous one. But let me just use the scenario of the equal highs. Then for this one is a higher high. Now let me tell you the difference between the mitigation block and the breaker. The mitigation block, it will create an equal high, or this one will be lower than the previous one. Before market will push down to break this block that is here and come back to it. This scenario is actually a mitigation block. Then this one where the market broke a structure before, it went to create a higher high before it came down and break this one, and then this one is coming back to it. It's called a breaker. So the difference between mitigation block and breaker is this highs. Are you seeing it? Is this highs? So let me draw a scenario 2 for mitigation block, or scenario 3. Okay, so let me draw scenario 3. All right, mitigation block, market moves from here, comes down, right, goes up, comes down, goes up, like this. Now it's not confusing, just rewash this part. If you don't get it yet, just rewash it. Now you're going to find that, are you seeing this? So that's what I mean. So this is also a mitigation block. Let me write it. Mitigation block. All right, so the mitigation block you see here, this particular high is lower than the previous one. This one is equal. These two are mitigation blocks. Okay, so that this particular block, this move that began from here that pushed this market up, did not take out this structure. it did not take out this structure before pushing down again. So market will come back to that block. That block is called mitigation block. But for this breaker, with the market that pushed here, the block that pushed this price up took out this structure to create a higher high, but now came down and break it down. So this is a breaker. So this is the only scenario for a breaker. Right? Mitigation block has these two scenarios. Okay, other block, there are many scenarios for other block, many scenarios. So there's no space here now. Okay, let me draw it. Let me draw another scenario for other block. Okay, other block, market goes up like this. Sorry, let me. So market goes up like this, comes down, then go up. Okay, so then as it was going up, there was, let's say, a red candle. There was a red candle in this place when it was going up. Okay, so if the market comes back from here to that red candle, let me use, oh no, okay, so if the market comes back to this red candle and pushes up, this is also another block. So that is also what? Another block. This block here is also another block. Are you getting me? So these are two scenarios for other blocks. So I'm going to show you all of these things I just drew now inside the chart right now. So you have to screenshot this part, and then this concept, we're going to be using it to analyze crash 500 right now. Okay, all right, have you screenshotted this part? Please take a screenshot. I'm about to clean everything. All right, so let's get to our chart. Let's get to our chart. Okay, so this is let me put our PO separator. This is crash 500 in the 4-hour time frame. You can do what I want to show to you now in any time frame. Let me switch to the H1. Yeah, okay, now this is really kind of all right. Let me use this one for example. The market left a low like this. You know, this is equal lows that was created here, right? This was an equal low that was created here. So this is how you know where market is likely going to move from. An equal low. Okay, so the market moved from here, and then it came down to this block. This is another block, but not really so, because it didn't really take out the structure. So I will not be taking a trade here. Why? Because the market has been ranging. So what I'll be waiting for is for market to break the range. Market has to break this range, the whole of this range. Are you getting me? It has to break it. All right, so let me draw again. So the market left this place. Okay, then it came down. Let me use annotation so that it will be faster. So the market left here, came back, went up, came back, and voila, broke it. Immediately it breaks it like this, you know it's time to place an entry here. You will place a buy limit here, this place. That's where you place your buy limit. Okay, so that's where you place your buy limit. So what happened? The market came back to this place and voila, pushed up. Are you seeing it? Pushed up massively, pushed up. So let me clear this. This would be, sorry, I'm having difficulty moving all of this drawings, so don't mind me. So the market came back to this block. Are you seeing it? And then it bought from here up to this level. This will be, sorry guys, I'm having difficulty moving my tools, okay, so don't mind me. All right, came back to this high. Are you seeing it? So that will be the high you are targeting. Immediately market breaks this structure like this up. This is a mitigation block right here, right here, right here. So this is how you buy to this level. So you put an entry, oh god, sorry, I'm having difficulty moving my tools. All right, okay, so you put an entry right here on the wick here, and your stop loss right here. Okay, that's 0.4%. If you move it up, there is more than 1:2 already. That's where you put your TP here, right on this high. You don't, except you want to trail, like you want to trade, but is like what I always say, the next high is where you put your take profit. That's how you trade it. Okay, that's how to trade the strategy. Once it breaks a high, breaks a range, it will come back to it and then you buy. Okay, it happens very, very often. It happens every time. This thing happens every time. Okay, the market, are you seeing this kind of thing? After that happened, then the market just began to create structures of an uptrend. Are you seeing this? So this is a structure of an uptrend. Immediately market begins to break highs, you wait for it to come back to the high. So this is one of the entry. This is another one here. How market left it and came back. Are you seeing it? And then you buy. Are you seeing it? So this is working every time. Are you seeing this one? Market broke it and came back to it. So once you've established the trend that okay, market is going up, you begin to wait for it to break a high and comes back and you say, these are cash spikes. You know, you have been seeing the spikes I used to drop in the group, like I will cash a whole 200 candles, like when you're on the 1 minute time frame now. So you see all those long spikes I used to cash. These are I cash them. I just place my entry at a top like this. Once market break any top like this type, I just place my entry there, my stop loss this in a place like this, and then you see just kissed it and started going up. So for boom, it will be spiking, while for crash it will be dropping, depending on whether you are buying or selling sharp. So but you can buy and sell any of them. You just don't trade on the smaller time frames. Don't trade on 5 minutes, 1 minute. The spikes will stop you out, like you will be in a loss, big mess. So what I'm trying to tell you now works every day, works every time. Okay, so this is how I look at crash 500 all the time. This is how I look at it. Okay, so the market works, it is working, it's not going to stop working. The strategy is like that. So that's the way trading is done. Okay, sometimes when this particular low here that was broken, after market broke it like this, came back to it, not just immediately, and then dropped down like this. Okay, so market came back to it again and broke it and came to this one, the first one I was here, then dropped down again. Okay, so the market will always respect the strategy that I'm showing to you guys. It works in binary, it works in forex. So these are I trade crash 500, whether on a buy or on a sell. I trade it like that. The same thing applies to Boom 1000. So I'm going to be doing different videos for all of them. Boom 1000, crash 500. You see how I use the strategy to trade. Okay, once the market breaks a low, you come back to it and sell again, depending on the trend. So you've established from this level that Market has been moving down, broke all the structure, has been moving down. So once it breaks a low, you know, since market is a downtrend, it will come back and continue selling. So that's what you do. Yours is to identify the trend, okay? Identify the trend every time. Identify the trend and trade in the direction of the trend. Once the trend changes, you will know it will be creating structures of a downtrend, lower lows, lower highs, to be creating it, okay? And you are not going to be forcing the market. Market will always come back. Just wait every time. Be patient. Once you see a very clear one, you don't have to force it. Let it be clear with for your eyes to see. Let it be clear. If your eyes is not seeing it, then don't trade it. If it's not, you don't have to force it. There are no special way to trade market. The thing will be clear. If it's a downtrend, it will be clear in your eyes. If it's an uptrend, it will be clear in your eyes. Then once market breaks a low in a downtrend, you wait for a retest and you sell. Then if it breaks a high in an uptrend, wait for a retest and buy. That's how you use the strategy to trade. I hope this is helpful and you find this interesting. Please, if you like this video, if you like this kind of what you are looking for and it gives you more confidence in your trading, then please, you can just like it and drop a comment. Appreciate me by subscribing to this channel, share it with your loved ones, and all right, see you next class.